Hello and welcome. When the stock market takes a dive, it's natural to feel a sense of panic. Seeing your portfolio value drop can be unsettling, even downright scary. But what if I told you that within those temporary paper losses lies a hidden opportunity? An opportunity that sophisticated investors use every year to lower their tax bills and potentially boost their long-term returns. This strategy is called tax loss harvesting, and it might sound complex, but its core concept is surprisingly simple. It's not about avoiding losses, it's about making those losses work for you. In this video, we're going to unlock this secret weapon. We'll explain exactly what tax loss harvesting is, walk through a clear, step-by-step example, and outline the crucial rules you must follow to implement it correctly in your own portfolio. Let's turn market lemons into tax lemonade. At its simplest, tax loss harvesting is the practice of selling an investment that has lost value to realize a capital loss, which you can then use to offset your capital gains or even your ordinary income for tax purposes. Let's break down the key terms. First, there's a capital gain or loss. This is simply the difference between what you paid for an investment, also known as your cost basis, and what you sold it for. Then there's the idea of realizing a loss. A paper loss is just a number on your statement. It only exists on paper. You only officially lock in that loss for tax purposes when you actually sell the investment. Think of it like this. Imagine you bought a nice watch for $1,000. A year later, it's a bit scuffed and the market for that model has dropped. It's now only worth $600. You could just be sad about it, or you could sell it for $600, use that $400 loss to get a discount on your taxes, and then immediately use that $600 to buy a different, but very similar watch that also tells perfect time. You're still in the watch-wearing game, but you just got a tax break for your trouble. In investing terms, you're selling a loser to capture a tax benefit, then reinvesting the proceeds into a similar, but not identical asset to maintain your market exposure. It's a strategic reset of your portfolio's cost basis. Let's make this concrete with a real example. Imagine you have two ETFs in your taxable brokerage account. First, ETF, which is an S&P 500 fund. You bought $10,000 worth, and it's now worth $15,000. You have an unrealized gain of $5,000. Next, you have ETF B, a total stock market fund. You bought $10,000 worth, but now it's only worth $7,000. You have an unrealized loss of $3,000. So, the market has a bad week. You see that ETF B is down. Here's your tax loss harvesting play. First, you sell ETF B. By selling it for $7,000, you realize a $3,000 capital loss. Now for step 2, you use that loss. This $3,000 loss will first be used to offset your $5,000 gain from ETF A. So, instead of paying taxes on a $5,000 gain, you now only pay taxes on $1,000. And if your losses were actually greater than your gains, you could use up to $3,000 of that excess loss to reduce your ordinary income, like your salary. Any losses beyond that can be carried forward to future years. Now for step 3, and this is the most important step, reinstate your position. You now have $7,000 in cash from the sale. To stay invested in the market and benefit from its eventual recovery, you immediately buy a similar, but not substantially identical investment. For example, you could sell the Vanguard S&P 500 ETF, which has the ticker VU, and buy the iShares S&P 500 ETF, ticker IVV. They both track the same index, but are different funds from different issuers, so it's allowed. What's the result? You've maintained your desired asset allocation and market exposure, but you've just created a $3,000 tax deduction that saves you real money. If you're in the 20% tax bracket, that's $660 back in your pocket. Now, this strategy is powerful, but the IRS has rules. Breaking them can nullify your harvest and could even lead to penalties. Here are the non-negotiable guidelines you need to follow. The first and most important is the wash sale rule. This is the big one. The IRS prohibits you from claiming a loss if you buy a substantially identical security 30 days before or 30 days after the sale. So what is substantially identical? Well, selling Apple stock and immediately buying Apple stock is clearly a wash sale. Selling one S&P 500 ETF like VU and buying another like IVV is a bit of a gray area. but it's generally considered not substantially identical because they're from different companies. However, selling VU and buying VU again within 30 days is definitely a wash sale. This 30-day window is critical, so be careful about things like automatic dividend reinvestments that might accidentally trigger a repurchase during this period. The second rule is to think long-term, not short-term. Tax loss harvesting is a long-term portfolio management strategy. Don't let the tax tail wag the investment dog. You should only harvest losses in investments that you still believe in for the long run. Don't hold on to a terrible investment just for the potential of a future tax loss. It's not worth it. Third, be mindful of your cost basis. When you reinvest, you're establishing a new, lower cost basis for that new investment. This means your potential future capital gain will be larger when you eventually sell it down the road. So, you're deferring taxes, not eliminating them entirely. But since $1 today is worth more than $1 tomorrow, this deferral is still very valuable. And finally, remember that this strategy is primarily for taxable accounts. You cannot harvest losses in tax-advantaged accounts like IRAs or for 101(k)s because those accounts don't trigger capital gains taxes in the same way. For many beginners, the simplest way to implement this is to use a robo-advisor, as most of them have automated tax loss harvesting built right into their algorithms. But understanding the principle allows you to spot opportunities and make smart decisions in your own portfolio. So, to quickly recap, what is tax loss harvesting? It's selling investments at a loss to offset your capital gains or income, which in turn reduces your tax bill. How does it work? You sell the losing investment, capture that loss for your taxes, and then immediately reinvest in a similar asset to stay in the market. And what are the rules? You must strictly avoid the wash sale rule by not repurchasing a substantially identical security 30 days before or after the sale. Tax loss harvesting transforms the inevitable downturns of the market into strategic opportunities. It's a reminder that in investing, it's not just about what you make, it's about what you get to keep. By being proactive and understanding these rules, you can keep more of your hard-earned investment returns and accelerate your path to financial independence. Thank you so much for watching. If you found this helpful, please give it a thumbs up and subscribe for more content.